Hi, welcome to our first 2022 episode of Insights and Indicators with Jason Thomas. Through Insights and Indicators, we at Carlyle aim to help you concisely understand the investment environment implications of global and local economic trends. Today, we're focused on the implications of digital transformation for 2022 and beyond. I'm Jonathan Blank in Communications at Carlyle, but I'm just here to facilitate a conversation with our head of global research, Jason Thomas. The data referenced in this podcast episode is up to date as of January 11th, 2022. Jason, thanks for joining us on the heels of developing a research paper on 5 questions for 2022.
Thank you.
Jason, I believe it would be helpful for all of our listeners if we started by reading a quote from your recent paper that provides a metaphor for how the pandemic catalyzed views on how technological change can lead to business changes. In your paper, you say by providing a sudden glimpse of a digitized virtual future, the pandemic was the rare event that allowed people to conceive of the transformational potential through new technology. It was as though the copper wire telephone network suddenly failed and people had to resort to cell phones. So technology advances occurred out of necessity in 2020 and 2021. Now, in 2022, what types of businesses will emerge as winners because of this forced technological revolution? Will the winners be technology companies? Or should we think about the potential winners of this revolution differently?
Well, thanks very much. I would say that what I'm trying to emphasize is that when people think about technological revolutions, just as the one we're going through right now, they really need to focus on who's adopting the technology and why. Because very often, no matter how great the technology, there are people who are making do without it. And it's not always immediately obvious why there's a benefit to embracing a new technology. And as you captured in the quote, the pandemic was something that everyone had to effectively lean in on digital technology. And they recognized that not only did it allow them to thrive during that real world business continuity test in March of 2020, but also allowed for much faster growth, wider margins in the subsequent months and years. And so really the point here is that when you're living through a period of very rapid technological adoption, and we are, if you look at business spending in the United States, spending on data, digital, and related R&D software is actually up 16%. At the same time that spending on all other forms of business investment has actually declined since the onset of the pandemic. You have to then ask, well, why is this adoption occurring so fast? And the answer is, again, management teams that see value in adopting that technology. And an example of this that we saw in the past was really the 1995 to 2005 period. And so at that time, there was a revolution in computing power, personal computers, and then, of course, software. And this revolution was embraced very fully by the retail and manufacturing sectors. And in those sectors, what you saw really starting in 1995 was this 30% growth in spending on warehouse management systems and the related technology. So that's things like barcodes, remote barcode scanners, databases, inventory software systems, warehouse automation. And so all this massive amounts of spending was, of course, very good for the tech sector. Their revenue surged. But it actually turned out that the returns on that technology in retail and manufacturing exceeded the cumulative returns earned by the tech sector over that period of time. And much of it was really related to just the dramatic improvement in business fundamentals. You had a 57% increase in productivity as a result of that investment. And then also a substantial decline in inventory to sales ratios as the barcodes, the scanners, the databases, the software allowed for a reduction in required inventories because people could more precisely measure what their customers were actually buying and then calibrate production or purchasing schedules accordingly. So I think that today, when we look at who are the potential winners of digital transformation, it's a circumstance where people have to look beyond the tech sector and start to think about what sorts of businesses, professional services, manufacturing, hospitality, are really leaning in and are the most aggressive adopters of technology and doing it in ways that are actually going to really get the most out of digital marketing, digital engagement, data capture, data storage, data analytics, cloud-based software applications. Because I think that when investors can perceive where the highest returns to those investments are, they're also going to, of course, recognize who the ultimate winners of this transformation will be.
That's really interesting. Jason, let's go back to your observation that in the 1990s, there were indicators of companies leaning into developing technology capabilities. And some of these examples were the adoption of barcodes and databases. Are there indicators now in 2022 that you believe we should all follow that are corollaries to the ones from the 1990s to understand which industries and businesses are adapting through digital transformation?
Well, I think when we think about 2022, the first thing to note is really the acute worker shortages that are faced by so many businesses. And as we look at the last really 60 years of data, it's interesting to note a very tight correlation between worker shortages and the subsequent years' total factor productivity growth. And really, the reason that relationship exists is because when businesses can't find workers, they tend to invest more in labor-saving technology to achieve the growth that they're looking to achieve, even when they can't find that marginal hire. And so the first thing I would say is that perhaps we will see another leg of the digital spending that I referenced, up 16% since the onset of the pandemic, as more businesses turn to digital marketing, digital engagement, in lieu of hiring additional sales workers, for example. I think also when you look at hospitality and retail and restaurants, et cetera, you do see much greater use of digital technology, QR codes. Will QR codes be like the barcodes of the 1990s in terms of facilitating productivity gains and revenues at these various businesses? To what extent can smartphones be more fully exploited in some of these sectors? And then I think on an ongoing basis, you have data capture, data storage, data analytics, but also the potential for the platforms, digital platforms that connect buyers and sellers, that allow for greater degree of collaboration. And also many of these platforms have network effects such that the marginal improvement in the service rises non-linearly with each incremental user. And so I think that there's a lot of potential for disintermediation. If you survey CEOs entering 2022, they are 15 times more likely to cite as the key risk facing their business the technological revolution unleashed by the pandemic than they are the risk from the pandemic itself. So that I think really helps to contextualize that in many business services, professional services, that there is a sense that there's a potential intermediaries, consultants, broker-dealers, that they could be displaced by many of these sorts of platforms that can provide comparable services in a way that is quite different from some of the traditional businesses and models. Ultimately, I think this is a phenomenon that will be concentrated in areas where there are worker shortages. Again, retail, hospitality, bars, restaurants, et cetera. But I think that there's also quite a bit of change ahead when we think about business and professional services and some of the functions that can now be performed by software and then also these networks.
Now that we've explored how wide digital transformation could impact the investment environment, let's turn our attention to valuations. In your paper, you said it's not the sector in which a firm operates that determines its equilibrium value, but the mechanics of its growth. With that in mind, how should we think about tech valuations as we go through 2022?
Well, first, technology valuations, all growth valuations, are under some pressure at the start of 2022 because of the expected rise in interest rates. So the Fed is expected to be much more aggressive trying to contain inflation than I think most market participants expected 2 to 3 months ago. And for these growth valuations, the reason that they're under pressure from higher rates is that they're generally long duration companies. That is to say that more of their total free cash flow is expected to arrive in the distant future. Many of these businesses lose money today, are not expected to be profitable for some time into the future, sometimes outside of the relevant underwriting window. So when rates go up, that means the opportunity cost of losing money today goes up, which hurts the valuation. It means that higher interest rates also depress the terminal value of the business on which their valuation depends, because, of course, the further into the future the cash flow arrives, the more heavily discounted it is and most sensitive to rates. So this is an issue, and it will continue to be. But the bigger issue in technology valuations, and from my perspective, is actually trying to separate the substance of what makes some businesses so valuable versus the form of what industry in which a company operates. And so the substance, what really makes some of these businesses so valuable is the potential for essentially scale-free growth, where you are able, as a digital business, to increase revenues without any incremental hiring, with very little to no incremental CapEx. These businesses are just have the potential for exponential earnings growth and a path for that growth that makes them, equilibrium basis, just simply more valuable because they have a potential that simply doesn't exist for many businesses or that did exist in the industrial age. When you think about industrial age businesses, the only way that they could increase revenues is to build more factories, to buy more equipment, to hire more workers, to build out bigger distribution networks with truck or rail or what have you. And so the growth came with significant costs. And that meant that there was not quite the same ability to scale their earnings. And so what we see today, I think, is many businesses that actually have industrial era properties, which is to say that they cannot increase sales without incremental spending, but yet they're being treated as though they're digital platforms with the potential for exponential or nearly infinitely scalable growth, simply because they happen to be called tech or green tech or medical tech, and I think that is where to the extent that there is a big correction here right now. Again, there's just, I would characterize as market volatility related to rates, but to the extent that there is really a significant pullback here, I think it's going to be those businesses that are really have more of those industrial era per unit economics that are carrying tech valuations that are going to experience the biggest declines.
Well, Jason, I really want to thank you for your time today to take us all through the implications of digital transformation and the related indicators we should follow over the course of 2022.
Thank you.
And we'll be back for our next episode with Jason shortly with his outlook and perspective on China.